guys, welcome to Finance Today. So far we've learned what a stock is, how to buy stock for a long position and make money when a stock increases in value. We've learned how to sell stock short, so you make money when a stock decreases in value. So today we're going to go over what actually makes a stock go up or down, what makes a stock move. Now there's a lot that goes into this, so we're going to pick out some major reasons and we're going to analyze those. So to understand how a stock moves, you have to understand the process of how a stock comes to be. So when a private company wants to be traded on the public market, maybe for liquidity, maybe because they want to grow as a company, they consult an investment bank. Let's use Facebook as an example. In 2012, they wanted to go public, so they hired Morgan Stanley to consult their initial public offering. What an investment bank does for a company trying to go public, they'll help them determine a set number of shares to offer to the public at a specific price. Ultimately, this determines a valuation that they believe the public is willing to pay for a share. Now, this is very important because it will begin the company's life as a public company, traded on the open market, and if it goes wrong, it can be disastrous. The best example of an IPO going wrong that I can think of was WeWork in 2019. WeWork and SoftBank, their core investor, initially valued the company at $50 billion, thinking that their assets were worth much more than they were and that the public would pay $50 billion in market capitalization. So they realized that the public wouldn't pay $50 billion and the valuation was chopped down from 50 to 40 to 30. It ultimately landed at a valuation of $5 to $10 billion. They wiped the IPO completely. WeWork never went public, and the CEO, Adam Neumann, was kicked out of his role. So we know that in an IPO, the firm going public consults an investment bank to determine the supply of shares and the specific price that are offered to the public. All of this is approved by the SEC before the shares are made public. But after that initial supply and price is put out to the market, everything is determined by the investors and the laws of economics. Economics say that the price of a good is determined by the supply and the demand for that good. So we know when it comes to shares, the supply of shares is set in stone when a firm IPOs. That means that the price is mainly determined by the demand for that share. If investors have high hopes for a firm that just went public and they believe that they will increase their revenues year over year, they're willing to pay a higher price for the shares on the open market. High demand equals higher price of a share. Now, if they have negative thoughts about the company, they don't think that they will perform well, then they will not be willing to buy a share. When it IPOs, they won't be willing to buy it until it sinks significantly in value. So low demand for a share equals a lower valuation and a lower share cost. Now we've talked about how changes in demand can affect share price. Now changes in supply can also affect share price. When a company conducts a stock buyback, it's typically because they have a lot of cash on hand and they want to own more of their company and drive the share price up. How they do this is they buy their own shares back from the open market, and this decrease in supply increases the share price. On the other hand, when a firm is trying to increase the supply of shares on the market, they can either do a stock split or they can issue new shares. Let's use stock splits as an example. Let's say that you are an investor in Uber. You have 100 shares of Uber. Uber announces that they are doing a 1-to-2 stock split. So today you have 100 shares in your account. You hear the news that Uber is doing a 1-to-2 stock split that evening, and the next day you will see 200 shares of Uber in your account without doing anything. Now, the only thing that's going to change is the value of the shares. They will be approximately half of the value. This is because you're doubling the supply, but holding the same underlying asset the same. Now, the other way that a firm can increase the supply of their shares on the market is by issuing new shares. So they'll do this if they need more money to expand their operations or grow, and they typically issue new shares at whatever price their shares are currently trading at. All right, so to summarize, in an IPO, the firm that's trying to go public works with an investment bank to determine a set number of shares at a set price, which is then offered to the public for investing. Now, once shares are on the public markets, the laws of economics truly determine the price at which shares trade for. This is because buyers and sellers are paired up automatically in these markets, and supply and demand dictates how much people will pay for the shares. Now, people have tried to make equations, models, formulas that outline why shares trade the way they do, but it really comes down to human nature and what people are willing to pay for the shares. So when you're thinking about investing in a firm, you're looking towards news and other events to try to see if the firm will go up because of the news or if they will decrease because of the news. You want to pay attention to history, and you want to pay attention to the principles outlined here. Thanks for tuning in. Hope you enjoyed learning about how a stock moves and what makes it move. Now, make sure you like the post, throw any questions and comments down at the bottom, subscribe on all platforms, and turn on post notifications for all of our upcoming content.